Please, I need you to kindly confirm that you can hear me before I progress.
Good evening, sir. We can.
Okay, that's great. Okay, so let us get to work this evening. So tonight we are going to round up on foreign subsidiary. So we started this over the weekend, and if I remember, I actually taught you about IS 21 that talks about the effect of changes in foreign exchange rates. And I told you that this standard will look at two areas. The first is the accounting treatment of transactions and events in foreign currencies. That is, when you consummate transactions, whether you buy goods or you offer service or you take a loan, any form of transaction in foreign currency, either the supplier is a foreigner or the buyer or the seller, whoever, but the transaction is in foreign currency. So that was what we dealt with last week. How do you recognize such transactions in your books? The focus for tonight is when you move beyond just consummating spot transactions in foreign currency, that you now have either a branch or a subsidiary or an associate in a foreign country. We call those entities foreign operation. And the foreign operation we want to look at tonight is that where the foreign operation is a subsidiary. So tonight, we are going to look at how do you translate the result and position of that foreign operation into the parent reporting currency or into the parent presentation currency. On Saturday, when we're looking at how do you treat transactions and events in foreign currency, we looked at some definitions of of exchange rates. We looked at what foreign currency is. We looked at presentation currency. And there is one terminology called functional currency, which is extremely important because this currency is the currency that we work with. In fact, this is the currency that we use to report our account in most cases. And this currency is usually the parent presentation currency, functional currency. And we said this currency is the currency of the primary economic environment in which the entity operates. And to know which currency is an entity's functional currency, we need to identify the currency in which sales prices are denominated, and also the currency of the country whose competitive forces and economic reality determines the sales prices of its goods and services. Those are determinants of functional currency. Those are the primary indicators. And there are secondary indicators as well. By looking at the currency in which funds from financing activities are obtained and some other determinants as well. Then we narrow down into looking at what foreign currency transactions are, which is when you have transactions in foreign currency. Then we looked at how do you recognize this? We said they are initially recognized in the entity's functional currency by converting it from that foreign currency the entity's functional currency at the date of the transaction. And we said at the end of the year, all monetary items should be translated using closing rates. And for your reminder, monetary items are similar to financial assets. They are assets to be received or liability to be paid in a fixed unit of currency. So when we say monetary item, that's what you're expecting is you're expecting a fixed amount, or you're supposed to pay a fixed amount. And the typical examples are trade payables and trade receivables. Those are monetary items. Then we go on to things like loans or even your cash and cash equivalents. These are monetary items. Opposite of that is non-monetary, like PPE, intangible assets. Asset or liabilities that the amount you're expecting to receive or pay is not fixed, it's variable. You're not sure how much you use to settle. Those are non-monetary items. And we said that all non-monetary items should be translated at historical rates. And that goes to show that when you buy an asset, a PPE in a foreign country, when you want to enter it in your books, you enter it in your books at the spot rates, the date you bought it, you just get the exchange rate, you use that to translate. At the end of the year, you don't retranslate the naira amount of that asset again because the standard here says that it should be translated at the historical rates, meaning whatever time it is in your book, it will be translated at the rate when you bought it, at the rate you bought it, at the exchange rate at that date when you bought it, right? But items like receivables, payables, those ones, they are. So when you consummate transaction in foreign currency and you are now owing somebody, you have trade payables, right? That trade payables, when you want to put it in your books at the end of the year, you need to look for the exchange rate at the end of the year. That therefore means that payables, the amount at which you recognize it initially in your books will be different from how much you are now going to put it at the end. So there will be some level of difference in terms of the naira amount. Because if you have translated it before at certain rate and you're not translating it again, is that the amount goes up or down? See that difference, we call it exchange difference, which could either be favorable or unfavorable. If it's favorable, it's a gain that goes to P or L. If it's unfavorable, it's also, that will be a loss that would be recognized in P or L as well. And we looked at some questions that we solved like 3 or so questions, question 1, question 2, and also this question. And I can remember that I asked you to go and solve this because it's similar to this particular one, just for your practice. So I wouldn't know whether you'd actually solved it or not. But we need to move forward. And tonight, we're looking at a scenario where we have foreign operations. So, where an entity has a foreign subsidiary, the parent entity must translate the account of the foreign subsidiary from the subsidiaries functional currency to the parent's functional or presentation currency. The exchange rate that is used to translate the items into the parent's functional currency depends on the following. Number one, whether a subsidiary has the same functional currency as the parent, and two, whether the subsidiary has a different functional currency from the parent. So this two is what determines whether the rates of exchange you are going to use to translate the items. So the first scenario is where the subsidiary or where the foreign subsidiary has the same functional currency as the parents. And how did you know? So this is demonstrated from the following. Number one is where the subsidiary is run as an extension of the parents, such that the goods sold by the subsidiary are imported from the parents, and it directly remits the proceeds from the sales back to the parent. So where is such a way that the foreign subsidiary, they run it as if it's an extension, that everything is selling is the parents that send it to him or to it. And as soon as he makes sales, he remits the money back to the parent in such a way that the transaction between the parents and the subsidiary are in high proportion. Is in high proportion. So majorly, all the goods that the subsidiary buys, he buys it from the parents. So the transaction between them is in high proportion. Not only that, the cash flow of the subsidiary directly impacts the cash flow of the parent. So if he makes money, the parents will know because all of his money is directly remitted to the parent. He doesn't accumulate cash. He doesn't. Any cash he makes, he sends it to the parent. And also, the funds, the subsidiary uses to operate are borrowed from the parent. So that's where the foreign subsidiary has the same. If all this happens, it means that they have the same functional currency. But where the foreign subsidiary but where the foreign subsidiary has where the foreign subsidiary has a different functional currency in the parent. I will get to this, okay? But where I'm going is this. So in this case, in the case where the foreign subsidiary has the same functional currency as the parent, in this case, the accounts of the foreign subsidiary will be translated to the functional currency of the parent in a similar way as that of a foreign currency transaction, as mentioned earlier. That is, all monetary items should be translated at the closing rates, while all non-monetary items should be translated at the historical rates. But where the foreign subsidiary has a different functional currency from the parent, and this is like the opposite of what I mentioned above. So this happens where the subsidiary is 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 autonomous, and operates independently, such that its source its goods and services from outsiders, and it accumulates the cash proceeds from the sales of its goods or services and its transaction where the parents are in low proportion and it's independently finances its operations, does not wait for the parent. So in this case, the account of the foreign subsidiary will be translated to the parent's functional currency, using the following principles. Number one, all assets and liabilities are translated at the closing rates the share capital of the foreign subsidiary is translated at the historical rates. The pre-acquisition reserves of the foreign subsidiary is translated at the historical rates. The post-acquisition reserves is determined as a balancing figure, and all income and expenses are translated at the average rates, and exchange difference arising from translating opening net assets at opening rates and the current year assets and liability items at closing rates should be recognized to other comprehensive income. Okay, so in most questions, they will not tell you. You will not be told whether the subsidiary has the same functional currency as the parent or not. So if they don't, so we assume that the subsidiary is autonomous. We assume that the subsidiary operates independently from the parent. That's what we always assume. That is it doesn't have the same functional currency. So when we want to consolidate, we will usually translate the account of that foreign of that foreign subsidiary using this approach. where all assets and liabilities of the foreign subsidiary, you translate it at closing rates. Share capital translated at historical rates. Pre-acquisition reserve translated at historical rates. Pre-acquisition reserve translated at historical rates. Post-acquisition reserve is determined as a balancing figure, and all income and expenses are translated at average rates. And because this post-acquisition reserve is determined as balancing figure, and year in, year out, this closing rate will be different. The closing rate of last year will be different from the closing, because closing rate means the exchange rate at the year end. So because we are using different exchange rates for asset and liabilities, for share capital, for income and expenses, and we are getting this as balancing figure. So there will usually be exchange differences. The account will not balance. There will be some exchange difference that we need to capture. Okay, and usually it's because when you look at the opening net assets, we have translated it at the closing rate of last year, which I'm now calling opening rates. And the current year asset and liabilities, you are translating it at closing rates. So that exchange difference, we need to always determine it and recognize it to other comprehensive income. And of course, is this income becomes the income of the subsidiary, right? Or loss of the subsidiary, because is a translation from its books on its books. So it is gain or loss. It is gain or loss. So let's look at a few questions to practicalize all of this. If you look at this company, they give us the abridged, they give us the abridged, we have, they give us the abridged statement of financial position and statement of profit or loss and other comprehensive income of Fredco and its foreign subsidiary Monaco as below. We're given the statement of financial position of the two companies, and you'll see that Fred, we're given his accounts in its own functional currency, which is Naira, and Monaco, which is our foreign subsidiary. This is his own currency. Let's call it R. Additionally, they also give us the statement of profit or loss and other comprehensive income of the two entities, the parents and the foreign subsidiary. Then they give us some additional information. They said Fedco has acquired its interest in Monaco since the incorporation of the company. And they give us the exchange rate on incorporation of Monarch, on acquisition of non-current assets. On 31st December 2006, they gave us average rate of 2017, and they also gave us the closing rates as at 2017. We're now required to prepare consolidated financial statement of Fredco. We're required to prepare consolidated financial statement of Fredco. Okay, I need to clean up. Okay, so let's quickly do that. Now, to do that, we have already established that this is a foreign subsidiary, and for that reason, before we can consolidate, this one said the question is long. No, it's actually short. This one is very short. When we start your intensive, you'll see long question. So the first thing we do, we have established that this is a foreign subsidiary. So to consolidate is very straightforward, really. But we cannot consolidate this guy's account when he has presented a statement in another currency. So the first thing we need to do is to translate. And we're not told whether this foreign subsidiary has the same functional currency as the parent or whether it has a different functional currency. But we assume that it has a different functional currency. You always assume that because, of course, since they are silent, we assume they operate independently. So because of that, we're going to translate all assets and liabilities at closing rate, share capital and pre-acquisition reserve as historical rates, post-acquisition retained earnings as the balancing figure, income and expense items at average rates. So let me start with statement of financial position item. So really, the step one of what we do is for you to translate the statement of financial position of Monarch. And we'll get Monarch exchange rate from Monarch to Naira, then would get the amount in Naira. So the first item here is plants and it's 600 in his books. So plants, and that's 600. The second item here, after plant, in the books of Monarch, is inventories, because this one is not in the book of Monarch, investment. So inventories of 400 in the book of Monarch. The next item is receivables. And is how much?
300.
200.
It's 300. Okay, 200, sorry.
Yeah. The next item is ordinary share capital. And how much was the ordinary share capital?
200.
200. The next item is retained earnings. And how much
560.
is that? 560. The next item is long-term loans. And how much is that?
220. Current liability.
Current liabilities. And is also how much?
220.
So let me just leave space for total assets. Now, let's start with the assets first, the asset part. Which exchange rate are we going to use here? The year end here is December 2017.
The 2 rand.
Why? Why are we using that?
is at the closing rate.
Thank you very much. So all assets and liabilities are translated at the closing rates. So this is 2. This is 2. This is 2. The liability is 2. This is also 2. Okay, what about the share capital?
At 4 naira.
Why?
At historical rate.
Thank you. At 4 naira. Does it have any pre? Of course, it cannot have pre. So that means this will be the balancing figure, right? For this. So this, are we multiplying or dividing?
We're dividing.
Multiplying.
Okay, so let's take it one by one. Somebody said dividing, somebody said multiplying. Let's start with the multiplying. Why are we multiplying? Oh, okay. Person is not
Because
sure.
because the naira has value than the rand.
Okay, so if the naira has more value than the
Sorry, sir.
rand,
It's dividing to reduce. This one has more value than the rand. Rand, if it is to convert to rand, it's multiplied. To naira is divided. It's division, sir. Sorry.
okay, good. Now you understand it. So naira has more value. So 600 rand is only 300 naira. 400 rand is only 200 naira. 200 rand is only 100 naira. It's 200 divided by 2. So our total assets here, we should be looking at 600 naira. Share capital, what's 200 divided by 4? That should be 50. So this is balancing figure. What's 220 divided by 2? That's 110. And this is also 110. I know that the total here should be how much?
270. Okay, balancing figure.
Yeah. So what's the balancing figure?
Sorry, sir. Current liability is 110, not 100.
Oh, okay. So what's the balancing figure?
270 minus this is 330.
830. 830. Okay. So like I taught you in the last class, you don't want to make mistakes when you are translating. The easiest thing is to know whether you're going to multiply or divide. Like Hussein properly analyze it. He looked at it and he saw that Naira has more value because look at the examiner already gave us the rate of exchange that 4R is equivalent to 1 Naira. So Naira clearly has more value. So when you want to translate to Naira, you divide. If Naira has more value, so that means 600 rand here is only 300 Naira. Naira has more value. So we did 600 divided by 2. If it was in a scenario where it was rand that has more value, where 1 rand is 4 Naira, then you have to multiply to get Naira if rand has more value. So if you analyze it in that order, you would not get it wrong. The important thing is don't ever get it wrong at this level. Always get it right. Okay. So Sarat, I don't know if I was able to help you like that. Step 2, we're going to translate the statement of profits or loss of Monaco R to Naira. So what are the items in the P&L? We have profit before tax of 320. We have income tax expense of 160. And we have profit for the year of 160. So for P&L items, income and expense, which rate are we going to use here?
The average rate.
Average.
Thank you very much. We are going to use the average rates. So, and what's the average rate here? It's 3.2.
2 to 1 naira.
3.2 to 1 naira. So we divide. So what do you have here?
100.
100. What about here?
50.
50. So what's the balance?
50.
50. Now that we have translated, I think we can confidently go ahead to prepare consolidated accounts because we now have the account of the subsidiary, the foreign subsidiary in Naira. So what we need to do first, we want to consolidate, is for us to determine goodwill. Abi? And here, was the consideration transferred to the subsidiary? We paid 50 naira to the subsidiary. We paid 50 naira to the subsidiary. And what's the net asset acquired? Since we acquired the subsidiary since incorporation, that means we won't have any pre-acquisition reserves. So that means the net asset we will have is basically the share capital of the subsidiary. As you can see here, is 50 naira. So this 50. That means the goodwill is nil. So I didn't bother putting NCI here because the parent acquired, he has 100% holding in this subsidiary. He acquired all his shares. We don't have any non-controlling interest. Additionally, we will then need to determine what we call exchange difference. This, nobody will ask you to do this, and they might if they are nice, but it's something that you need to always check if it's there or not. You have to check without being told. So how do you determine exchange difference? You see, I already told you what usually results in exchange difference is actually coming out from this balancing figure you are getting. There would be an inherent gain or loss inside. Because of the fact that we are using different exchange rates, different exchange rates. We are using closing rates, we are using historical rates, we are using average. And don't forget, this profit for the year is also inside, it has already gone inside there. So, and not only that, this retained earnings is something that it is cumulative. So last year again, we will have used, what was the exchange rate last year? Yeah, we will have used 4 rand as the closing rate. So all of that, you need to do some kind of reconciliation to see the gain or loss as a result of using different exchange rates. The gain or loss as a result of using different exchange rates. And there are different ways of doing that. I will show you 2 ways. One way is to look at this post-acquisition retained earnings that we have. It won't work. No, it won't work. So there will be only one way that we can use here, which is determining my opening net assets. Okay, I will look at what rate did they change it. And my opening net assets would be, I don't even know my opening net assets, but if I want to get my opening net assets, I can get that as my closing net assets if I remove profit for the year. I should go back to my opening, because really when we say net assets, in this case, net asset is just share capital and retained earnings, or assets minus liabilities. That's my net assets. So if I want to get my net asset at the beginning of the year, my share capital is the same year in, year out. So what changes every year is retained earnings. And what changes it every year is the fact that we are making profit every year. If we are not paying anything as dividend, then your retained earnings increases proportionately with the amount of that profit. So if I want to say, okay, what's my opening? I just need to remove, okay, let me remove my profit for the year from these retained earnings. It takes me to the retained earnings at the beginning. And that clearly gives me a sense of my opening net asset. So if I say my closing net assets, which is my share capital, which from here is 20, it's 200, I mean, my retained earnings, which here is 560. Then my closing net assets is actually 760. If I take away my profit for the year, which is 160, that brings me back to opening net asset, which is 600. You see that I'm doing it in rand. I'm doing it in rand. Why? Because I want to translate it at the opening rates, rand to naira. I want to translate it. And the opening rate was 4 rand to 1 naira. So my opening net assets in naira was 150. If I add my profit for the year in naira, I want to work back to closing, which was 50. My profit for the year in Naira is 50. That means my expected closing net assets in Naira should be 200. But it wasn't. It wasn't 200. My closing net assets in Naira, after translation using this year's closing rates, if you check it out, is share capital 50, retained earnings 330. It was 380. It was 380. So this 380 is what we sorted. This difference, which is a gain, because I'm expecting 200 as net asset. I got 380 as net assets, which is a lot of money. So there is an exchange gain here of 180. Usually it will go to OCI of the subsidiary, Monarch, OCI of Monarch. So you need to be an expert in doing this, because there is no way you want to solve any question on foreign subsidiary. This one will take like 4 or 5 marks. So I think just have an understanding of this approach, that exchange differences, we're just trying to do a kind of reconciliation to establish the effects of using different exchange rates at the end of every year. And the fact that your retained earnings is cumulative, and you are using different exchange rates every year. So there will be some differences as a result of using different exchange rate. Differences will arise. And to determine that reconciliation is for you to do it yourself, to see it yourself. So you determine what's the opening net assets? Let's translate it and add profit for the year. Let's look at the expected closing net asset. So I determine opening net asset, and no one will give you. So I need to understand the fact that my opening net asset is my closing minus profit for the year. So it's like I'm working back to the beginning of the year. And again, I've told you, share capital, except if they told you that they issued share capital during the year, then that means you have to remove that one to work back to opening, right? So majorly, the difference between opening net asset, closing net asset is usually profit for the year, because that's the one that change. Share capital doesn't change, it's there. So we remove it. And I got my closing net asset, share capital plus retained earnings. In foreign currency, I got my closing. Then I deducted my profit for the year. In foreign currency, I got my opening. And I translated it at the opening rate. That last year, this was the opening. Fine, I got this. I now assume that, okay, let me add profit for this year that we got. My expected closing net asset in Naira should be this. But it was this we have as my closing net asset in Naira. So, and that's differences I want to establish as a result of using different rates. The fact that we used 4 Naira last year, and this year we're using 2 Naira, that would result in this retained earnings to have some element of gain or loss. And this makes sense that it's gain, because it was 4 Naira before, and now it's 2 Naira. Naira is getting much more value. So we would have some gain in terms of Naira, which is why we are having this gain that we have in our books. Okay, now having established the exchange gain, which is the gain of the subsidiary. I think we can then do the consolidated retained earnings, which is the retained earnings of the parent. Who's the parent? Is it Fred? No. What's the name of the parent? Okay, Fred. Okay. So as per correction or date of consolidation, what was the Naira retained earnings of the parent? 600. How about Monarch? What was the
330.
Naira? Yeah, 330. Are we going to add the exchange difference to that of Monarch? Ordinarily, is a gain of Monarch, but we can't add it here because it's an OCI item. It's an OCI item. It's different from OCI goes to, this is a special, a separate reserve in equity. You don't mix it up with retained earnings. Okay, that's the only reason why it's not going to come here. So Fred's share in Monarch gets the entire 100%. Get everything. That's how much. Gets the whole of the 930. Get the whole of the 930. So now we can prepare our consolidated statement of financial position. As that year ended 31st December 2017 in Naira. The first item, which is plants, that would be 700 plus 300. That gives us how much? 1,000. Second item, investments. We cancel out this. Goodwill was 0. Inventories, that's 450 plus 200. That gives us how much? 650. Then we have receivables, which is 300 plus 100. That gives us how much?
400.
400. What's my total assets?
1,050.
Sorry?
1,050. Oh, 2,050.
2,050. So my equities and liabilities, share capital, that will be share capital of the parent, just 600. Consolidated 10. How much is that?
930.
Again, long-term loans, that'll be 100
Plus
plus
1.
110. 100 plus 110.
210.
How much?
210.
Which again?
Current liability.
Liabilities,
200.
200 plus 110.
110.
How much?
10.
Is it 210 or 310?
310.
310. Okay. Can we sum this together?
$2,050 there.
So still on FREDCO, we have consolidated statements of profit or loss and other comprehensive income for the year ended December 2017. So we have profit before tax. Parents has 400. Parent has 400. The subsidiary has 100. So 400 plus 100, 500. Income tax. What is the income tax parents? 200. The subsidiary has 50. So 200 plus 50 is how much? 250. This gives me profits for the year, which is how much?
750. Sorry, 250.
Then other comprehensive income is the exchange difference. How much was it? 180. What was the total here?
$430. 430.
430. And that's the end of this. That's the end of this question. Any observations, please? Let me start question 2. I can't finish it because I want to end this class by 10 a.m. a bit 10 p.m. So for this one, it says Regis acquired 70% of Faris for 6,000 rand on 31st December 2014 when the retained earnings of Faris were this. So we're given some of financial position, similar of profit or loss. Then they gave us the exchange rates. And they say it's a good policy to measure NCI at acquisition at proportionate share of the fair value of identifiable asset. Okay. And I asked to prepare statement of financial position, consolidated statement of profit or loss, and other comprehensive income, statement of changes in equity attributable to equity holders of the parents, and all that. Okay. So the first thing we do, which is step 1, we know that this is a foreign subsidiary, so don't even stress. Just translate the statement of financial position of the foreign subsidiary. In this case, is Faris. And what's the rate? It's also R here. So R, so N, then N. So what are the items here? PP, 6,000 R. And investments, nothing here. We have current assets, 4,500 rand. And total assets, we're looking at 10,500. Then our share capital, 3,375. In this case, there was pre-acquisition retained earnings, which was 6,000, Shabi? No, 1688. 1688. And post-acquisition retained earnings. What is the post? Anyway, if the retained earnings is 5,925 and the pre is how much is the pre?
1688.
Then post is 4,237. 4,237. Okay. Then my long-term loans is 1,200. 1,000. Then I'm sure this should add up to 10,500. Maybe. Can you confirm? Does it add up?
Okay, you are correct, sir. It's 10-5.
Okay. So remember, all assets and liabilities will be translated at the closing rates. What's the closing rate here?
Three rand, that's 31st December,
Okay,
217.
okay, 3. So this 3, and this 3. Share capital will be translated at historical rates. What's the historical rate here?
It's, 3.8.
Why?
No, okay, no, sorry.
4 rand.
Yeah,
4.
right. Because we
214.
acquired the subsidiary in 2014.
It's
So
214.
that's 4. What's the pre? Also be translated at historical. Why this will be the balancing figure? So you already know that in this case, Naira has more value because
Yes.
4 rand to 1 Naira, 3 pound like that. Naira has more value. So we divide to get to Naira. This obviously is 2,000. How much is this? This should be 1.5 now, maybe.
Yes, sir. Three, five.
3375 divided by 4, that is 843.75.
Just approximate 844. How about this?
688.
422.
422.
Balancing figure. And this?
400.
400.
We expect the total to be how much? To be equal to this, Abi?
350. Yes, sir.
3.5. So what's the balancing figure?
42 minus 400. 1834.
Okay. So back. Step 2. We're going to translate the statement of profit or loss of Paris rand onto Naira. In rand, what's the revenue? This is 8550.
855.
8550. What's the average rate? 2.9.
2.9.
How much in Naira?
That's was
Okay.
2027, 28,
Let me just extract it.
2028.
Okay. Let me extract all figures first. 3705.
Sir, it's not 2.2020. That is wrong.
Okay, what is it?
It is 2,948.28. 2,948.28.
Okay, thank you. So I have my operating expense 855. And I have my profit for the year 3990. Profit for tax. Now my income tax as 1140. I have my profit for the year as 2850. Okay, so let's translate. You can be giving me the figures.
Cost of sale 1278.
So what would the gross profit be?
$1670.
How about the operating expense?
$295.
295, sir.
What was the PBT?
1375.
1376.
76.
Okay, 76.
36.
But this is 5 now.
You've
What
been
was it?
approximating the other one, sir.
Okay. Okay, so what's the income tax?
393.
393. What was the profit for the year?
983.
983. Okay, so we have translated. So the next thing is for us to determine.
The profit before tax is 1325, not 6, it's 5.
Okay.
Profit for the year is 982.
Okay. Thank you. Now let's get our goodwill. Now, how do we get goodwill? We'll do consideration transferred. How much? $1,500. Now we have non-controlling interest, which is measured at proportionate share. So we need to get net assets acquired. So the net asset acquired, we have the share capital of the subsidiary, which is now this. The pre-acquisition, which is this. So we should be looking at 844 pre-acquisition. Translated it at
42.
2. So the total of how much?
1,088 naira. 1,088 naira.
So this guy is going to be, how much is this?
Sir, the acquisition is 422, not 244. It's 422.
Thank you very much. So this is how much?
1266.
1266. So how much do we have?
It's a 37, let's just say 380 approximately.
380. So this gives me 1880. So what's the difference?
$614.
614. So these are goodwill, but this goodwill was a goodwill, of course. Is this historical goodwill, the money we paid when we acquired in 2014, and this is net asset as of 2014. However, this is 2017. In our books, we cannot put this goodwill here in 2017 because this goodwill was arrived from a foreign subsidiary. It was determined from a foreign subsidiary that we translate. So, unlike if it was a local company now, the goodwill is just there to just be there forever. But this one will be changing because of the changes in exchange rates. So how do we adjust for that here? How do we capture that here? So the best approach is this, right? We'll have this 3375. We have this 1688. What was the addition of these two? 3375 plus 1688.
5,063 naira.
Okay. You know that it was when you translated it from, what was the rate? What was that historical rate? When you use that,
2.5.
that
4.
that naira, that's when you get this. Can you try it? Do you get this?
5063.
Yes, sir. It's
Yes, sir.
1,265.75. Approximate, yes. Approximately, yes.
Okay, good. So my goodwill as at 31st, when did I acquire? December 2014.
24.
Is that 614. But